Hey there. So today I'm going to walk through, in this video, we're going to go over all the different purposes and styles and compare those to the property types and really try to understand how the different purposes and investment styles correlate to different risks and rewards in commercial real estate. That's a lot of words. Let me just say it like this. There's another video, which you can see in the comments below, I'll link to, in which I went through and I mapped out the risks and rewards of all the different property types in commercial real estate. But that's really only half the equation. The other half of the equation would be to say, it's not enough to know the property type. I need to know what the borrower is going to do with the property. Is it going to be a purchase, a refi, construction? What are they going to do? That's going to have a dramatic impact on the risk involved on that particular deal. Obviously, it's going to have a dramatic impact on which type of lenders and loan programs that we need. But before we even get that far, we just want to kind of understand how do different property types correlate to the different purposes and investment styles. So by the end of this video, you're going to understand both the combined understanding of the risk and rewards on the different property types, and then we can map on top of that all the different purposes and business plans for the different properties, and really get finally a true picture of the risk and reward on any different type of real estate investment just from knowing these two bits of information. What's the business plan and what's the property type? So let's get started. First, I just want to review the kind of the universe where we're talking about. A loan or property could have a couple of different purposes. It could be a purchase. It could be a refinance of an existing loan. It could be a renovation of a property. And that renovation is obviously a wide spectrum of different things. There could be a light renovation, what we might call a cosmetic renovation, where they're just doing some light work. Maybe they're renovating the units or painting the interiors or redoing the landscaping. I would call all that cosmetic versus more infrastructure. They're redoing the roofs, the plumbing needs to be redone, there's some electric work, we're moving walls around. That's much more a heavier lift. But that's all under generally what's going to be a short-term project on a renovation. And then construction, which obviously has its own set of concerns. That's how we look at it in the lending sphere. But if you were an equity investor, you might talk about things a little bit differently. You might talk about core plus, value add, repositioning, and construction. This could be repositioning, repurposing, heavy renovation. There's a lot of different terms that could go in here, kind of the same idea correlating to renovation. But an equity investor really doesn't think about these terms because they're not involved in a renovation. I mean, they're not involved in a refinance. They don't think in terms like this. They think more along the lines of this. Core would be, when you think about buying a stabilized property, very high quality property, probably new within the last 10 years. That's core. You're not going to do anything. It's a stabilized property. You're coming in, you're going to do a little bit of work, very light renovation, just make some general improvements. That's core plus. Now I'm coming in to make some unit renovations. I might improve the interiors, some new flooring, some new kitchen appliances. I'm going to spend a couple $1,000s per unit or just on the general interior. That's now going to be value add. I'm adding value to the property. Repositioning, now this is much more substantial. Repositioning would really mean to me, if it's a hotel that we're repositioning to become an apartment building, or it is an office building that we're repositioning to become multifamily or hotel. Any kind of a switch in asset type would be a significant reposition. But reposition, again, can mean anything from a heavy renovation to a complete repositioning of the asset type. And finally, this construction, which generally means there's a piece of land and we want to build from the ground up. We call that ground up construction. Sometimes it might be where we're tearing something down or there's an existing structure and it's so much complete renovation that we consider it construction. But in general, equity investors think about things like this. And then finally, you might talk about the property class. I tend to see this more in the larger cities, on the larger asset types, really when you get above $10 million. I mean, that's a loose figure because it's going to depend on where you are in the country. But generally in A-class properties, new within the last 10 years, it's in good condition. There's really nothing to do to the property, good neighborhood. You're talking, major city, downtown location, great locations in that city. A- needs a little bit of work. B minus. By the time you get to C, it's already in a different type of a neighborhood where people who are in A property aren't going to be living, shopping, or working in a C property, generally how I think about it. We'll always say from a multifamily standpoint, and as many of you know by now, my background is largely in multifamily, where I was involved with a family office, helping them to acquire, a lot of property along the East Coast, nearly 9 figures worth of property. And, we always talked about it like this in multifamily. People who are in A-class apartment property, which tends to be, let's say, of a garden style apartment property, it's going to be with a nice, it's built within the last 10 years. If it was older, then it's been significantly renovated. Everything's luxury, beautiful lobby and interior, on-time staff, on-time maintenance staff, beautiful pool, recreation facilities, and amenities. Great. That's an A property. People will move from an A property to a B property because generally they're still in a good area, good school district. Just the property might be a little bit older. Look, we're in the mid 2020s right now. So if an A property was built between 2015, 10 years ago, and now, then maybe these properties were built in the late 90s or early 2000s. They're still not old properties. You're just a little bit older. Um, People would move from an A property to a B property if they lost their job or if the economy changed or something kind of affected their family situation. But very much people in a B property, an A or B property, do not want to move to a C property. It's just probably a different demographic, different part of town. It's really a significant step down where crime, security, and issues like that may become more of a factor. And I guess there are D properties, but really, I don't never really use the term for a D property, at least not in multifamily. But in general, the types of properties that the people we work with would be probably, A and B class, A minus to Bs. The A's are really the higher equity investments. There's not really a lot of money to be made in an A class property. It's fully stabilized. It's more like a bond. You're just writing a check every month. You're getting a low return. Um, Bs are where people generally go in and make significant renovations and try to get them up to become an A and get those rents. But that's pretty hard to do. Maybe you could take a B up to an A minus, but and that's the spectrum. So now let's look at all of this together. And what I want to begin to do is kind of map this on a chart. So I'm going to erase all this. Give me just a second here. I'll do this quickly. We're going to erase all this, and we're going to make a little bit of a chart where this is risk, reward. Terrific. Now, what we can do is take those different investment styles and purposes, and because some of them overlap, and we're going to begin to model them. And this is going to be risk to reward. So if I look at my higher risk, what's going to be highest risk? Intuitively, we understand this. A piece of raw land, all the work to go into the infrastructure and improving the land, and then building from the ground up. The cost of construction materials can change at any time. The amount of work that's involved, the architecture plans, the blueprints, the electric, everything that goes into building, that's clearly higher risk than buying a stabilized property. So it might look like this. Let's put my little dot up here, and that is construction. If I go to the other end of the spectrum, come down over here, this is going to be your core. See how purpose doesn't really take it? Because purpose could be anywhere along, not purpose, purchase, an acquisition, let's say, buying a property could have multiple different styles involved. So purchase doesn't really capture what core captures. Core means it's just a very stabilized property. There's not much to do with it, very low risk. Then I'm going to have core plus, value. This might be a heavy renovation, and this might be a repositioning, which I would look at core, going up the scale, a little more risk, a little more reward, core plus, value add, renovation, and then repositioning, and then finally construction. And if you can think of anything above it, let me know. I'm happy to add it. But that's really where I stop and understand. I was just going to think maybe there's raw land, but I don't think I would consider raw land because it's really speculative. You're just holding on to it. In any case, this is how you would look at the risk and reward of the different investment styles. And here's where it gets interesting. What if I now map onto this the different property types? If you remember, if you've seen the other video, and if you haven't, you should go watch it. Again, there's a link down below in the comments. But I'm now going to map their property types on top of this. We had said that the highest risk property type was a hotel, and that the lowest risk property type was a triple net lease or maybe an industrial. And then we said over here might be, I think I said self-storage, multifamily. And then I went up, we said it was office and retail. Now, why do I like to do this? Because I can see very clearly, if I have a multifamily property renovation or a multifamily property that's core or a multifamily property that's construction, I'm kind of mixing. I've kind of got middle of the road risk reward for multifamily, but the construction type makes it a little more risky. and maybe more reward as well. And if I had industrial core property, we might say that that is very safe. It's your ultimate, right? It's probably very low risk, also probably very low reward. And then I can move up. So you can kind of mix and match these two together. There's another way I like to look at it, which goes something like this. Again, I'm going to take a good look at this. I'm going to erase that just for a second because I think I have a better way to display this to you. And I'll include a PDF down in the comments. You can ask or click to get the PDF. And you don't have to always write this down, but I would look at it like this, which might be something like this: core or plus, value add, reno, and construction. And over here, I can make the same thing. I'm going to put my property types: triple net lease, industrial. I have self-storage, multifamily, office, retail, and hotel. I just like this one because what am I looking at now is I'm saying, I might say up here that I have higher risk, lower risk. And now you can really see it because now they're laid out next to each other. If somebody comes to me with a property and they say it's triple net lease or industrial core, I'm like, oh, for me, I call this term double low volatility, right? Very low volatility, very low reward, very low risk to that type of a deal. If I have, it goes up the spectrum. Triple net lease could be core plus, could be value add, could be rental, could be construction. And I can just see, yes, it's lower on the risk, but the investment style increases that risk a little bit. I can mix and match here. And again, if I had hotel and construction, that would be the highest risk type of deal. And intuitively, you can understand this. I just think it's nice to look on a chart like this, where you can really quickly see how they all go together. And if you keep this in your mind, we've now really increased the value of this line of thinking beyond just being able to map property types against a risk and reward spectrum. We can now layer on top of that the different investment styles, and now we have the complete picture, right? Now you really have the understanding. Where you could go a little bit more, even more sophisticated than this, would be to map onto this the borrower's level of experience. More experienced or less experienced would increase the risk as well. And the way to look at this is, imagine you're the lender or the equity investor, and it's your money that's going to work. You're taking it out of your pocket and you're going to give it to a borrower. You're the lender, you're going to give it to the borrower. You're the investor, you're going to give it to the borrower. You're an LP investor, they're a GP investor. You want to really be thinking all of this through. And then you want to map onto that the borrower's level of experience. Above all and beyond this, how much reliability, how much credibility, how much trust do you have that this borrower has the ability to pull off this investment thesis, right? Because there's a lot more work involved and a lot more sophistication involved and a lot more experience needed when you go up the spectrum into construction. And similarly with the operational complexity on the different property types. So I wanted to get this out there, and I wanted you to see that there's you really need to combine. It's not enough just to understand the properties and where they are on the spectrum. You also need to add on top of that, what is the business plan for that property? And you can also understand why just purchase refi is not enough, because you could have a purchase of any of these properties, or you could have a purchase and it could be core or core plus or value add. Value add, I'll tell you where the distinction is, because this might come up as a question. What's the difference in a value add and a renovation? And I might say it like this. A value add is probably still a long-term loan versus a renovation construction are both short-term loans. And I'm making that distinction long to short-term at 3 years. So 0 to 36 months would be somewhere in this or somewhere in here. I'm sorry, somewhere in here. And anything longer than 36 months might be here. It would depend on different lenders have different programs for value add, especially in the multifamily area, where they sometimes will allow you to do some kind of renovation and include that in the loan amount. If those programs aren't available or the renovation is too substantial, then it'll really be more of a specific renovation, almost a short-term construction loan or a short-term bridge loan. Make your renovations, make your improvements, then change over the rent roll, right? Get the new tenants in there at the higher rent. And then once it's stabilized, fully renovated according to your plan, now it's stabilized, now you go refinance into a long-term loan. It just depends on what kind of loan programs are available. But you'll see now, if you look at Fannie and Freddie and some of the other lenders, that they have these kind of value add loan programs available. So it could be a long-term loan, but it includes a renovation. So that's, you just need to kind of dive into that a little bit more. And that's it. I hope that helps. If you want to learn more about this, like I always say, there are links down below to the 8Cap Academy, or if you need a platform to help you kind of manage all of your originations, you are always welcome to learn more about 8Cap AI, the platform. And that's it. Thank you very much.